Now let's look at the structure of the Federal Reserve a little more closely. What you see here at the base of the Federal Reserve System are the private banks in the economy. They have to belong to the Federal Reserve System. And these private banks hold stock in the Federal Reserve System, and that stock allows them to vote for directors in the Federal Reserve System. And the directors appoint a president for that particular bank. And the president and the Federal Reserve banks, they form a central part of the Federal Reserve System. And there's a Federal Oversight Committee by the 7 governors, Board of Governors, in the Federal Reserve banking system. And the governors and the bank presidents form the Federal Open Market Committee. And the Federal Open Market Committee, the FOMC, set monetary policy for the Federal Reserve, for the economy, basically. Now, those 12 districts are laid out here. Now you can see it makes sense to understand when the Federal Reserve was created in 1913, right? In 1913, New York held a lot of power financially in terms of that was the financial hub of the United States. And so most of the economic activity was taking place on the East Coast. So you could see the East Coast of the United States has 6 districts. The rest of the United States has only 1, 2, 3, 4, 5, 6 in total. So this is the vast majority of the geography. You know, keep in mind we've got Alaska, that's Alaska, and Hawaii over here. They're part of the 12th district. So the vast majority of at least the land is not evenly distributed in terms of districts. And the 12th district is headquartered in San Francisco. The 9th district is headquartered in Minneapolis, and so on. And so these cities represent the headquarters for the Federal Reserve in that particular district. Oh, let me get rid of this. So the 12 district banks are operated in a fashion similar to that of private bank. They have a board of directors, we have discussed that, they issue stock, and they have bank officers. Now, what are the tools the Federal Reserve can use to manipulate the economy? Well, the Federal Reserve controls the money supply, and that's the key to their influence on the economy, the control of the money supply. And the money supply influences the business cycle. Now, some of the old tools that the Federal Reserve has used are things like reserve requirements, discount rates, and open market operations. And we're going to be going over these 3 in this lecture, and these are primarily covered in your textbook. But keep in mind, the financial crisis of 2008 required that the Federal Reserve develop new tools to combat a terrible, terrible situation. And some of those new tools were things like quantitative easing, buying mortgage-backed securities from the public, paying banks interest when they keep money with the Federal Reserve. And do I have any more? And swapping short-term treasury bills for long-term treasury bonds. Now, we're not going to be going into these new tools. I just want to let you know that these are the traditional tools at the disposal of the Federal Reserve, but those tools weren't working effectively, and so it required the Federal Reserve to develop new tools in the last financial crisis. Now, as we discussed in the previous chapters, the money supply can be categorized into one of 2 categories, M1 and M2. And these are classifications of money based upon liquidity. Now, the Federal Reserve requires banks to keep a minimum amount of reserves, and we call those required reserves. And manipulating the reserve requirement can manipulate the amount of money that the bank can create. So by changing the reserve requirements, the Fed changes the level of excess reserves in the banking system and thereby changing the ability of bank to lend. Now, as we discussed in the last video, the money multiplier determines how much in additional loans the bank system can make based upon excess reserves. If there are no excess reserves, the banks cannot make any loans. If banks can't make any loans, they can't create any money. So a change in reserve requirements causes a change in excess reserves, which leads to a change in the money multiplier, and it changes the lending capacity in the banking system. Now, I want to let you know right now, Federal Reserve seldom ever changes reserve requirements. So in other words, this is a tool that they don't really use very often. Now, another tool that they can use is the Federal Reserve can actually loan money to banks. So banks have a tremendous amount of profit incentive to keep their reserves at close to their reserve requirement levels, because previously bank reserves did not generate any interest for the bank. It's like money collecting dust in their vault. Well, if the Federal Reserve, if banks needed to borrow money because they're running low on excess reserves, and they could borrow money from another bank, or they could borrow money from the Federal Reserve. If they borrow money from the Federal Reserve, the interest rate that the Federal Reserve charges them is the discount rate. So you could see that if the Federal Reserve lowers the discount rate, that could encourage banks to borrow more money from the Federal Reserve. But just like reserve requirements, banks don't like to borrow money from the Federal Reserve. One of the reasons why they don't like to borrow money is because the Federal Reserve is also a regulatory agency of the banking system. So what you don't want to do is really go to the regulator and ask for money. It's kind of going to your parents and asking for money. So the nickname for the Federal Reserve is the lender of last resort. Banks usually go to the Federal Reserve because they have nowhere else to go. That's just another way of saying banks don't borrow money from the Federal Reserve very often. So the discount rate, or manipulating the discount rate, is a tool that's seldom used. Now, in times of crises, banks do borrow from the Federal Reserve. And you can see here, look at this. This shows bank borrowing from the Federal Reserve. And you could see in the financial crisis of 2007 and 2008, that skyrocketed, right? That's the banking crisis. And banks needed money because people, some of the assets that they were holding became less valuable, and that really affected the bank's balance sheet. And they needed to recapitalize. That's a fancy way of saying they needed money to prevent them from going bankrupt. And the Federal Reserve stepped in and allowed them to borrow money. Now, the tool that the Federal Reserve most often uses is called open market operations. And what open market operations are simply the Federal Reserve trying to manipulate a specific short-term interest rate. And the short-term interest rate is called the Fed funds rate. And the Fed funds rate is simply the interest rate banks charge each other for overnight loans. So if you're a bank and you're running low on excess reserves, what you can do is you could borrow excess reserves from another bank short-term, overnight basically. And the interest rate banks charge each other for that loan is called the Fed funds rate. And the Federal Reserve tries to manipulate that interest rate to manipulate short-term interest rates. Now, there are many other interest rates, many other short-term interest rates that are directly linked to the Fed funds rate. So you could see how if the Federal Reserve manipulates the Fed funds rate, it has a chain reaction and affects other types of interest rates. And it could even affect long-term interest rates, which is the biggest mover of economic activity in the market. So reserves borrowed by the one bank from another is called the federal funds, or the Fed funds rate. And federal funds are lent for short periods of time, usually overnight. And the federal funds rate is simply the interest rate banks charge one another for that borrowing. Now, I'm not going to go into discounting because I told you before, discounting is the interest rate that the Federal Reserve charges banks who want to borrow from them. But banks don't borrow from the Federal Reserve very often, so I'm not going to really talk about this. I'm going to be talking about open market operations. Open market operations are simply the principle, that's the main tool that the Federal Reserve uses to manipulate economic activity. Now, how they do that is they want to get either more reserves into the system or less reserves. Think about this. When a bank has excess reserves, they can loan that out to other banks. If the Federal Reserve creates more excess reserves, that's more to lend out, which means it becomes cheaper to lend out those excess reserves. In other words, the Fed funds rate or the interest rate drops. If the Federal Reserve wants to increase interest rates, short-term interest rates, or in this case the Fed funds rate, they want to reduce the supply of excess reserves. Now the question is, how does the Federal Reserve increase or decrease the supply of reserves in the system? Well, what they do is they simply buy and sell assets, particularly U.S. government treasuries. These are U.S. government bonds. And they buy these assets as a way to put more reserves in the system or take out reserves in the system. Let me give you an example. What if the Federal Reserve printed some money and they bought a used car? Now, when they buy that used car, they have to give somebody money for it, right? So the Federal Reserve gets a car. So let me see here. Here's the Federal Reserve. This is the Federal Reserve chairperson. The Federal Reserve buys a car, right? So he gets a car and he pays somebody money for it. Okay. Now, when the Federal Reserve issues money for this car, they're in essence putting money into the system. Now, what does this person do with that money? Well, he could deposit it in his bank, right? And when he deposits this money into this bank, reserves go up. And if the supply of reserves goes down, the Fed funds rate or the interest rate falls. What if they, instead of buying a car, they sell the car? Now the car goes this way, right? To somebody. And the somebody gives the Federal Reserve money. Now, how did this person get this money? Well, this person withdrew the money from the bank. And that means reserves have now fallen. And the Federal Reserve holds on to that money. If reserves are scarce, interest rates will go up. So do you see how they're using the buying and selling of automobiles as simply a way of putting money into the banking system or taking money out of the banking system? But the Federal Reserve doesn't use cars as the way to do this. What they use is bonds. They buy and sell bonds. Most specifically, government bonds, federal government bonds. And sometimes these are called, they have three varieties. They have Treasury bills, Treasury notes, and Treasury bonds. Now, the reason why they have three different names is these are three different types of bonds based upon the length of time the federal government wants to borrow money from you. If you want to borrow money short term, they issue Treasury bills. Medium term, Treasury notes. Long term, 10 years or 30 years, Treasury bonds. So usually the Fed funds buys and sells short term government securities. And like they're doing with this car, they buy and sell it. So if the Federal Reserve buys a Treasury bill, they get the Treasury bill and they issue money, and the amount of reserves in the banking system goes up. If they sell a Treasury bill, the Treasury bill goes this way and money comes back to the Fed, and money is taken out of the banking system. So that's how they do it. So the Fed's open market operations simply focuses on getting people to buy or sell government bonds. And that's how they attempt to influence the choice by making bonds less or more attractive, right? And when the Fed buys bonds from the public, it increases the flow of deposits in the banking system. And this is basically what I just discussed in that example, right? And so what we're going to do in the next video is we're going to examine this process of buying and selling bonds to manipulate a short-term interest rate called the Fed funds rate.